closed at that time because of the wars. Okay, so it is Wednesday, September 21st, and welcome to the Daily Energy Markets podcast. We have oil prices this week still gripping on to the low 90s, now trading this morning a little bit up above $91 a barrel. We look at the close yesterday, it held above 90, but it did seem that this market, at least in recent weeks, wants to continuously test that $90 floor. But more often than not, it seems to be able to hold above it. Let's kick off this morning with Neil Atkinson, the former head of Oil Markets Division at the IEA. Neil, welcome. The big story, I suppose, of the morning, of the day, that before we get to all things Fed, is the outlook for Russia's annexation of the eastern provinces of Ukraine. The thinking there is that if they have a referendum, all the people vote to join Russia, it becomes Russia, and then you attack it, you're attacking Russia, and the whole thing escalates. Your thoughts on this as a significant moment or not for the sort of direction of this war?
Oh, it could be a very, very significant moment indeed, because when the votes take place, I place a tiny little bet that Russia will get what it wants from the referendum. And as you say, it is an escalation. There's no question of that. And if on top of that, we continue to see the European Union and others move towards imposing tighter sanctions as we get towards the end of the year, the deadline, the 5th of December deadline, if there is a ratcheting up of tension on the ground in Ukraine, plus the imposition of sanctions, and throwing in one final factor here, cold weather early in the winter season here in the Northern Hemisphere, then we have got a recipe there for pretty severe market tension, and that means higher prices.
Ali Al-Rayami, consultant and former Director General of Marketing, Ministry of Energy and Minerals in Oman. Ali, the outlook for demand both in Asia and Europe looks somewhat uncertain, and yet oil prices remain above $90 a barrel. Your thoughts on why that is, and will they hold?
Good morning, everybody. And the uncertainties are still there, and they will continue. Like I said 1 month ago, that this situation and these uncertainties, they will be with us at least until end of this year and beginning of next year. But I'm not surprised to see the prices, stick to 90s. And I've said this before again, because the fundamentals are quite there. The demand is not very strong. Oil price is not as good as everybody expected. With this kind of a situation, we thought that the price would be 100 and 105 and 110. But because of the demand is not there, the growth is not there, the Fed, actions in America, and also the central banks in everywhere taking a lot of actions. And this kind of situation, they will always, try to reduce the pressure on the price. The war in Ukraine is also one of the factors. So there are so many factors. The Irani nuclear deal is not there anymore. So all of this, it shows you that nobody can predict what's price will be next week. We read a lot of reports from everywhere, but nobody is expecting the price to change dramatically. I think, again, the price is 85, 90 to 95. It's a very reasonable price. It's a reasonable range. And I think we'll continue seeing this for the rest of this year and maybe the first quarter of next year.
Let's welcome Yasser Al-Maliki, Gulf analyst at the Middle East Economic Survey. Yes, sir. We had overnight some pretty strong comments by the CEO of Aramco telling us that the oil prices, or that the oil industry has been neglectful of new investment, and so that this scarcity, this crisis will continue. Your thoughts on those comments, and in the context that OPEC Plus is now producing about 3 million below its target. How significant a stress is there, do you think, on maintaining OPEC Plus capacity even at these levels?
Thank you, Sean. I mean, well, first of all, we have to understand that, these comments show that Saudi Arabia is consistent with its messaging to the market. And on the, energy transition agenda. I mean, Riyadh, like other oil producers, have argued that investment in upstream oil and gas projects should continue, or else there will be a risk of supply crunch, which would lead to high energy prices. And, in a way, the events at Ukraine have accelerated that, have shown these impacts early. Now, yes, the underinvestment since 2015 has shown the effect on the upstream capacity, on the production capacity of many of these OPEC producers. It is quite hard for them to reverse many of them outright. And since 2015, we could say that the Emiratis and the Saudis and other OPEC producers have been shouldering any investment into the upstream sectors in their region, at least, and there hasn't been a similar pace in other places. But within the context of the energy transition and messaging, we have to understand also that the Saudis and the Emiratis, they have been trying to promote a low carbon transition agenda by promoting technologies like CCUS, blue hydrogen, green hydrogen, renewables, and so on. And they are actually trying to be technology leaders in that. And the latest messaging from the IEA itself is that, the consensus is now that climate concerns are at the back seat and supply concerns are, what drives the market.
I mean, all of the energy transition language, which I know is a favorite chestnut now of the oil industry to blame, if you like, but ultimately, the OPEC Plus countries couldn't give a toss about the transition and its impact on their investment. And so my point to you is the challenge to OPEC Plus countries, they're 3 million barrels below their quota. That would indicate that they are seriously struggling to maintain capacity, not because of green discouragement, but because of other profound reasons. What are those profound reasons, and are they likely to get worse?
Well, I mean, you have a plethora of reasons. As I said, you have the issue that revenues have been going down previously. If it wasn't for OPEC Plus coming together and cutting production, trying to get the prices up, we wouldn't have that in the last couple of years. Remember, also we had COVID-19, and that impacted investment as well. In places like Iraq, you had these things actually coming together with war on ISIS, for instance, 2014. And this is one of the reasons why Iraq is not simply just having problems with its upstream capacity, but also with its export capacity. You have countries like Iran, which is under sanctions, and has not been able to invest into its own sector. You have Libya, which has been coming up and down, depending on the politics of the country. So, of course, you have a lot of political risk. You have problems in terms of cash flow because of, oil prices not being high enough for a while, unless, OPEC Plus intervenes. At the same time, you have also a management issue. Not all NOCs are as professional as ADNOC and Aramco, which have been investing steadily into growing and expanding their capacity. Not everyone works the same throughout, the OPEC sphere of countries, I would say.
Right. Neil, despite everything we talked about in the earlier comments, gas prices are declining in Europe. The outlook for putting aside the possibility now of escalation in the war, but generally going into the winter, it seems like the stress is coming out of the energy crisis in Europe rather than escalating. Your thoughts, is that a misreading, or what's your outlook for that?
Well, with greatest respect, I think that is a misreading. Rather, as happened with oil prices just after the invasion of Ukraine, where they shot up to $139 a barrel. Nobody knew exactly what was going to happen. There's an element of knee-jerk response. Oil prices have settled down, or crude oil prices, I should say, not products. Crude oil prices have settled down since. And to some extent, that's what we've been seeing in gas, because the European economies have done a pretty good job in filling their inventories with gas ahead of the winter season. They've done a pretty good job. So you would expect that the heat, so to speak, to come out of the peak gas price. At one point, we had gas, I forget in which country it was trading at, but one of the major European economies, pretty close on an oil equivalent, on an equivalent energy equivalent basis to $600 a barrel. You know, and until fairly recently, it was still well over $400, $450 a barrel for gas. So, okay, coming down a bit, but prices are still sky high, and we have the uncertainty over the onset of the winter weather. And then as we speak, I mean, I've just seen a news flash come up on my phone, which is short and sweet. Putin mobilizes more troops and vows to use, quotes, all means available to defend Russia in Ukraine. So I would take that as a sign of potential escalation in Ukraine, which may have an even bigger impact than we've seen so far in the supply of oil and gas. And therefore, you know, I haven't looked at the price action this morning, I must confess, but I'd expect prices to start turning up again.
Ali, prices are, I mean, just on crude and Brent at least, above $91 a barrel. OPEC Plus now, they've just come through their last meeting where they had this sort of token reversal of the 100 increase, and then there was a cut. Your thoughts of where OPEC Plus goes into a winter in which China, all forecasting is to continue to be subpar in its demand appetite. Where do you think OPEC Plus goes now with all of the pieces of the puzzle that they're facing?
I think they go to the coming months and also for winter time. It's with a very open-minded. They will, they have agreed last time, that they will keep everything open. They will monitor the market on a continuous basis, and then they will react accordingly. And that is, I think, it's been always, OPEC Plus strategy, not to really to jump into a conclusion before we know the reasons for any kind of situation that we are in. So I think they will continue reviewing the market, and they will study whatever necessary or actions that need to be taken according to the realistic and also the fundamentals of the market conditions. But going back again, Sean, to your position or your question about the 3 million extra, or shortage or extra. Is it extra?
The gap between production and quota.
So, yeah, well, actually, it's a shortage of the compliance. I think you have to break down the numbers and see who are, who's not been able to produce the maximum or the numbers or the production that it's been requested from these countries. And if you can see that most of the major producers like UAE, like Saudi Arabia, like Kuwait, like Iraq, they are complying, and some of them are already above the production levels. Oman is one of them. So I think you have to break down and to see on each country why they have failed to fulfill their requirements, rather than just see the big number of 3 million without knowing the reasons. And I think Yasser, he pointed down some few of those reasons, but I think there are more than that. It's not like a shortage of investment or political reasons, but the technical capacity for some of those countries, it's not there. And they need to do a lot to be able to produce to their maximums. So I think there is some, and this, by the way, this will continue. it is not going to be reduced to 2 million or to 1.5 million in the coming few months. I think they will continue having this shortage for the coming 3-4 months in the future. So, and then again, I mean, this shows you again that there is no appetite in the market. With this shortage, we could have seen rocket, prices goes up to 100 because of this shortage. But because of the situation and the growth is not there, and especially in China and Asia. So that's why we see that the market is almost like balanced, actually. Yeah, with all this kind of crisis that we have in the world.
Yes, sir. I'd like to just touch on your thoughts as the central banks of the world and the Fed today go into a more aggressive tightening strategy. The cost of money goes up, and then obviously that impacts the ability of borrowing and the investment into new supply and so forth. But I want to get your own thoughts on the impact of this tightening cycle on the Gulf and the Middle East states, the oil producing states. Is it a good thing? Is it a bad thing? How does it play out from your perspective?
Well, I mean, it will depend on each country and how it finances its projects. So I think, again, with the Ukraine crisis, there is an emphasis on bringing investment into key capacities, especially gas. So you look at, for instance, Qatar. They had brought what everyone is calling their dream team. Shell, Total Energies, Exxon, and others. Into the North Field East project, which will boost their LNG capacity from some 77 million tons per year to 110, and the next phase is going to be announced soon, which will take it to 126 million tons per year. And you have a lot of interest also in the East Med, in North Africa, and so on. So the idea here is how these projects are going to be financed. Do they come from the NOC's monies, or do they come from monies that foreign investors bring in? In both cases, in both of these cases, I think it all depends on the internal finances of the NOCs and the majors, which should be a bit untangled from the situation. Not much entangled, but a bit less entangled. On other projects that require financiers and tapping debt markets and so on, especially solar and renewables, you will see some impact. You can already see this in some of the desalination projects in the region. There is a lot of refinancing happening. So there will be some impact there. But when it comes to oil and gas projects, I think it depends on who is delivering them. So I think NOCs will not have much of a trouble compared to others. But again, the impact is going to be across the board. Interest rates are going to be high, and the cost to get money is going to be high as well.
Yeah.
Neil, you wanted to come in on that, but I wanted also, Neil, to get, please follow up on that point if you want, and I'll follow up with a question.
Yeah, it's not just high interest rates that are going to have an impact, of course. What we're already seeing is high costs of the inputs for all these projects, whether it be raw materials, finished goods, labor costs. We've got supply chain issues. So yeah, Yasser's description there is absolutely spot on. And I would just add to the interest rate pressures, these other cost pressures, which are going to be very important in the next few years.
Neil, I wanted just to follow up with you on the developments in China. Clearly, China continues to be in a relatively subpar 10 million barrels of imports a day, having been up above 12 last year and the year before. But what's happened in most recent months has been, after some months of the opposite, China is now exporting a lot of products, given its capacity in refining, and the outlook for the rest of the year is for it to continue to provide increased quotas for Chinese refiners to export more diesel and products into Asia and international markets. Your thoughts on the outlook for that and the impact that it could have?
Well, that was partly due to the fact that Chinese domestic demand has been very weak. I mean, it looks as if 2022 will show overall Chinese oil demand actually slightly below 2021. I think that's the latest outlook. but that will recover because we're starting to see the easing of restrictions in these Chinese cities of 15 million people that outsiders have never heard of. They're going to start getting back to normal levels of activity. That will boost domestic demand, and presumably that will lead to lower exports. China is a huge key to where the market's going as we move towards the end of this year and into 2023. If the Chinese government is now not going to impose draconian closures of the economy because somebody sneezes, then you can see renewed demand pressures from China into 2023, and that is going to add to this very volatile and very confusing mix that we've got. Again, it's products, and you mentioned diesel, and this is the thing. We talk about crude oil prices, and I understand why, and that's very important. But the pressures in the market from product prices, particularly as they feed through to end consumers, have been very, very dramatic. We've seen jet fuel prices on an equivalent basis close to $300 a barrel earlier this year. We've seen diesel prices at very elevated levels. And why is that? Because globally there is pressure on refining capacity. We were talking about oil production capacity earlier on, and that's very important, but we should not overlook, and this has been highlighted, of course, during the summer, particularly by the United States, of course, that there is pressure on refining capacity too. And that raises more questions about investment in that part of the
But also the fact that China hasn't been exporting products over much of the year has compounded, because they do have a lot of idle refining capacity. We've got new refining capacity coming into the Gulf as well. So you would think some easing on distillate prices. Let's go to the survey question and just get the room's view on this point with the escalation in Russia. Would Russia's annexation of Ukraine's eastern provinces trigger an escalation of the war? A simple yes or no on that, because escalation there obviously has dominoes that could really be quite dramatic. Ali, looking into the sort of tea leaves that she becomes now of all things Iran, and the agreement a month ago, we were on the doorstep of the agreement. Now, a month later, it feels like it's as far away as ever, particularly with the US elections coming now very quickly. The reporting seems to indicate that the oil, that floating storage that Iran has been waiting to bring to the market under the lifting of sanctions may now come to the market without the lifting of sanctions, or at least start to sort of move into commercial selling. Your thoughts on that, and could that be of scale to impact a downward pressure to oversupply? What are your thoughts on the outlook for Iran talks and the further release of Iranian oil?
I've been betting on this agreement for the last few months.
I know. We all have.
They always, I'm wrong on this thing, and this is typical Irani tactics. You reach to very close to sign, and then you start from scratch again. So this is Iran. But it is not going to be easy for Iran to ease the floating oil. Everything is sanctioned, and they are monitored, and there are so many ways of monitoring these fleets and these tanks. So I don't think that they will be able. They have about 100 million barrels of floating oil and condensate. I think it's a huge amount of oil, and to take it to the market, I don't think that they will be able to do that. Maybe 5, 6, but more than that, I think it is going to be very difficult, and I don't think that the Europeans and Americans, they will allow them to do so. And there is nobody, unless there is an agreement between the countries, and America is accepting it. That could be okay. But without any kind of an agreement, I think it will be very, very difficult for Iran to export any crude more than what they do now. More than that, I think it's going to be difficult. So they will keep on floating until they reach an agreement.
let's look, Yasar, at the announcements now, the escalating announcements out of Russia this morning of this conscription, threats of utilizing nuclear. Clearly, Putin and Russia, in the aftermath of last week's meeting with Xi and with Modi, and some losses or setbacks on the battlefield, is starting to look like slightly cornered. Where do you see the geopolitics of this going for the Gulf, for India and China, staying side by side with Putin as he announces more and more dramatic possibilities?
I wouldn't. I mean, Sean, I wouldn't really say side by side. I would see the Indians and the Middle Easterns are more neutral on the affair, and they have been quite pragmatic. In terms of providing energy sources, oil, Middle Eastern oil has been increasingly flowing to the European side as, Russian barrels displace Middle Eastern oil in China and India. So they have been quite pragmatic with their approach. In terms of the effect of this recent affair, I think the recent comments from Putin and the move to conscript more troops, I think we have to understand there are two wars happening. We have a physical conflict and we have an economic conflict happening in Europe right now. The main problem that I see is what happens on December 5 when you have two things happening: a ban on Russian crude completely in the EU, and the EU starting to disallow financial insurance companies or maritime insurance companies from providing services to vessels that carry Russian crude and the products. And then by February 5, when the European Union stops getting all refined products. So one thing that we understand is that Russia is willing to do anything, from these comments, physically, in terms of the war itself. They want to continue the war. They are not going to have a beating. There is a reputation for the Russian Federation. There were expectations at the beginning of this war that it is going to be a security operation that's going to be handled quickly. And even Russian, generals, they had their ceremonial uniforms, with them, because they thought that in 3 to 4 days they will be in Kiev and they will be parading. But now the war is in trenches. The war is, as everybody sees, is going to advance the stages. On the other hand, we have to look at the economic side of it. Russia has almost halted completely the gas flows to Europe, and the European move to ban imports of oil and products from Russia completely and remove the insurance. Well, Russia might do the same in terms of oil, because if they are now willing to conscript more people and even move into a nuclear option, maybe, then the nuclear option on the oil market would be for the Russians to start reducing their oil production. And that is going to be problematic. In a nutshell, if we have the same dynamics that happened in the gas exports to Europe happening on the oil exports to the world, because Russia says if you are going to be involved in the price cap, even if you are a third party country, then we are going to not send you oil, then we are going to have a problem, unprecedented pressures on oil prices.
Let's get the survey result and give Neil the last word here. So an overwhelming yes on the escalation point, and no surprise there, I suppose. Neil, your thoughts on that last comment by Yasar, because I think that starts to bring that as the next probability. Why would Putin wait to be cut off on oil when he has the potential to reduced by 1 million barrels and oil prices would go to $200? Your thoughts on that strategy and the possibility and the impact it would have on Europe?
Well, I'm surprised that 74% wasn't a lot higher, frankly, but there we are. Yeah, I mean, he is escalating the conflict quite clearly. Although you have to wonder, conscripts are not always the most dedicated and ferocious of soldiers, and you have to wonder internally in Russia whether there is going to be some kind of backlash or resistance to the conscripts of young men to go and fight for something that they probably don't believe in. As far as the West is concerned, the European Union and the United States and others, we've gone all in against Russia in terms of economic sanctions. Come December, we're cutting off oil shipments. We're preparing to find alternatives to gas. We have gone all in. And I think also for us here in the West, there is no turning back either. We would lose all credibility if we were to weaken our stance against Russia in the face of this escalation from Putin. So, you raise the specter of $200 a barrel oil. That's a kind of figure which has been quoted from some analysts around the place. Nobody has any idea what it could actually get to, of course, because we're in uncharted territory. But this escalation, which we've been reading about while we've been talking for this last half an hour, clearly raises the game, raises the tension, and it will not be a surprise to see prices rising pretty sharply once the full implications of this sink in.
Absolutely, a different day, if you like, from the point of view of what this potentially could become. Doesn't sound to me like he got that kind of green light from Modi and Xi last week, but perhaps what was said behind closed doors was more relevant than what was said in front of the doors. Ali Al-Riyami, as always, lovely to have your insights. Thank you so much. Yasar Al-Maliki, thank you very much. And Neil Atkinson's, really appreciate your insights today. Oil prices, as we say, trading up sharply, about 2% at the moment on the news of the day. Good interview with Victor in China with some insights as to where China goes in the fourth quarter. Well worth listening to his comments. All the best. Thank you.
Thank you.